Welcome back to the deep dive. Today, we are doing something a little different.
Yeah.
Usually when we talk about this specific topic,
Huh.
cryptocurrency, digital assets,
Yeah.
everyone wants to talk about the charts.
Always the charts or the algorithms, the white papers, market caps.
Exactly. It's all very external. It's all very mechanical.
It is. It's like trying to analyze the machine. But today, we're doing the exact opposite. We are basically throwing the charts out the window.
Because as it turns out, the machine isn't really the problem. The user is. We are.
Right.
We're diving into a really fascinating piece of research. It's titled Crypto Fever, Decoding the Psychology of Digital Markets. And the premise here is just, it hits you right in the face.
It really does.
It argues that the real engine driving the crypto market, all the volatility, the bubbles, the crashes, it isn't technology at all. It's biology. It's our own psychology.
Exactly. It frames the entire crypto landscape not as a financial system, but as this massive high-speed playground for behavioral economics. And if you look at it that way, the market isn't a machine, it's a mirror.
A mirror. I love that, even if it is a bit terrifying.
It is.
Because when you look in a mirror, you don't always like what you see, right? We like to think we are these rational actors.
Of course.
We sit down, we look at the data, we make these calculated decisions about our portfolios.
Yeah.
But this source suggests we are actually just walking bundles of chemical reactions getting played by our own brains.
That is the harsh reality of it. And the mission for this deep dive, really, is to strip away all that technical jargon and just understand why we act the way we do when money becomes digital.
And maybe how our own brains might be, actively sabotaging our financial goals without us even realizing it.
Without us even having a clue.
So we've got a roadmap for today. We're going to look at these dopamine traps that get us hooked. And spoiler alert, it's not just about feeling good.
No, it's more complicated.
Then we'll unpack something called unit bias and why we're obsessed with cheap coins, even when the math proves we're being irrational.
And finally, we'll get into why doing absolutely nothing is sometimes the hardest psychological challenge of all.
It sounds so simple, just do nothing. But I guess as we'll see, fighting your own biology to achieve that stillness is one of the hardest things an investor can possibly do.
It really is.
Okay, let's unpack this. Let's start with the chemistry. The source opens with a concept called the dopamine loop phenomenon. Now, I think most people have a general idea of what dopamine is, right? It's the reward chemical. You eat some chocolate, you get dopamine. You get a like on social media, you get dopamine. But how does that translate to a digital wallet?
Well, think about what happens during a big price surge. We aren't just seeing numbers go up on a screen. The source explains that crypto assets are just known for their extreme volatility. So when you see a sharp increase, those big green candles, your portfolio hitting an all-time high, that's a direct biological trigger.
It's a rush.
It's literally a rush. But here's the nuance the source adds, which I think is fascinating. It's not just about the reward, it's about the unpredictability of the reward.
Okay, so in psychology, what is that?
They call it intermittent reinforcement.
Right. Break that down for us.
So imagine you have a button. If you press it and get $1 every single time, eventually you get bored. It's predictable. It becomes a job.
Okay, makes sense.
But if you press that button and sometimes you get nothing and sometimes you lose $1, but then sometimes you get $10,000, your brain just goes into hyperdrive.
Oh, wow. So that's basically a slot machine.
Exactly.
You just described a casino.
That's precisely it. Crypto is structurally similar to a slot machine in how it engages the brain's reward system. The volatility creates that, maybe this time, anticipation. Your brain's reward system gets flooded.
So it's the same mechanism that drives gambling addiction.
It is. You get this hit of intense emotion that just completely overrides your logic.
So when the market is pumping, my prefrontal cortex, the part of my brain that makes good decisions, is basically being held hostage by my lizard brain screaming, more.
That's a perfect way to put it. Precisely. But, and this is where it gets really interesting, the source highlights the danger of the flip side.
The crash.
Surprisingly, no, not the crash. The crash is painful, sure, it triggers fear. But the source argues the real trap, the one that destroys the most potential wealth, is the plateau.
The sideways trend, the boring part.
The boring part, the chop, exactly. When the market goes sideways or stagnates, that dopamine supply gets completely cut off. Psychologists call this a loss of stimulation.
It's like withdrawal then.
In a way, yes. When the volatility stops, the brain stops getting those reward signals. There are no high highs, no scary lows, just flat.
So you lose interest.
Interest fades.
Yeah.
You start feeling an emotional slump, a profound sense of dissatisfaction. You check your portfolio, nothing has changed, and you just feel annoyed.
You're just thinking, do something, go up, go down, just move.
And this is where the mistake happens. The source points out that people lose interest and they exit the market during these boring periods. They don't leave because they lost money. They leave because they lost their entertainment.
Which is so ironic, right? Because if you look at market history, isn't that usually where the best opportunities are?
That is precisely it. The text explicitly states that people leave exactly when the foundation for future trends is being laid. The accumulation phase is boring by its very design.
So we are hardwired to chase the excitement, but the market rewards the boredom.
That's the paradox. The brain craves the rush, but your portfolio often needs the quiet. If you're only engaged when your dopamine receptors are firing, you are likely buying the top because that's when the excitement is highest, and selling the bottom or the sideways period purely out of a need for more stimulation.
That is a terrifying thought.
Yeah.
You're trading based on your need for entertainment, not for value. You are paying a premium to be entertained by your own money.
Correct. And the market is more than happy to sell you that ticket.
All right, speaking of value, or our warped perception of it, let's talk about unit bias. This was a huge aha moment for me reading through this. It explains so much of the weird behavior you see in this space.
Oh, this is a classic cognitive error. Unit bias is fascinating because it just shows how terrible our brains are at intuitively understanding value versus quantity.
Okay, so give us the breakdown. How does this actually work?
The source uses a really great example. Let's say you have two assets. Asset A costs $100.
Right.
And asset B costs a tiny fraction of a cent. Let's say, I don't know, 0.00001.
So one is expensive, one is dirt cheap.
Okay, so mathematically, if you put $1,000 into both, and both of those assets go up by 10%, your profit is identical. A 10% gain is a 10% gain. The math doesn't care.
Right, math is math. My bank account doesn't care if I sold one rock or a million grains of sand if the profit is the same.
But your brain isn't doing math. Your brain is doing feeling. And the source explains that psychologically, it just feels more comfortable and substantial to own a million units of the cheap coin than it does to own a tiny fraction of the expensive one.
I feel seen. I mean, it just feels better to say, I own a million of these than I own 0.05 of that.
Exactly. It creates an illusion of substance. You feel like a whale because the number is big, even if the actual value is small. It's an accumulation instinct we have.
So what does this actually do to the market? I mean, it sounds kind of harmless, just a quirky preference.
It distorts the market significantly. The source connects this directly to bedal behavior. It explains why we see this disproportionate hype building around projects that have absolutely no technological value just because the token price is low.
It's the cheap illusion.
Yeah.
The whole penny to a dollar fantasy.
It is. People pour money into these things hoping the 0.0001 coin will go to $1. They completely ignore the market cap, they ignore the token supply, they ignore utility.
They just see that price tag and think, if this thing goes to $1, I'm a billionaire.
Right. It's a phenomenon called denominator neglect. They focus on the price, which is the numerator, and they completely ignore the supply, which is the denominator.
So that coin hitting $1 would mean the market cap would need to be bigger than the entire global economy, but
the brain doesn't calculate that. It just likes the idea of holding a large quantity.
so we are getting tricked by our dopamine, and we're getting tricked by our preference for big round numbers. But we aren't doing this alone, are we?
No, not at all.
We're doing this in groups. We're doing this in chat rooms.
We are. And that brings us to the next point, which is social inertia.
Ah, the echo chamber.
The crypto market is so unique because it lives so heavily on social media, Twitter, Discord, Reddit. The source describes these communities as the ideal environment for herd behavior.
It's hard to think for yourself when your entire feed is just screaming the same thing at you over and over.
That is the definition of the noise factor. When the information environment is flooded with repetitive success stories, I made 100x, this is the next big thing, we're all going to the moon, individual critical thinking just collapses.
It gives way to collective approval.
Totally. It's like, if everyone else thinks this is a good idea, who am I to disagree?
That's called social proof.
And in behavioral finance, and honestly, in evolutionary biology, it's an incredibly powerful force. Think about it. If you're on the savannah and the whole tribe starts running in one direction, you don't stop to calculate the trajectory of the threat, you just run.
Right, because if there's a tiger and you stop to think, you're dead.
Exactly. Better to be wrong with the herd than dead alone. In the market, this just manifests as FOMO. The louder the general noise is around an asset, the higher the probability that people are making decisions based on that social pressure rather than on facts.
So the more hype there is, the less actual thinking is happening. It's an inverse relationship.
Precisely. And here is the counterintuitive truth the source highlights. Real analytical work usually happens during periods of information silence,
When the hype has died down.
when the chats are quiet,
Yeah.
when the influencers have moved on to the next shiny object. That is when the real analysis happens. If you are making decisions when the noise is loudest, you are essentially just outsourcing your thinking to the herd.
And the herd is reacting to dopamine, not analyzing fundamentals.
It's all connected. The noise provides the stimulation triggers the dopamine, and the critical thinking just shuts down. It's a vicious feedback loop.
Okay, I want to pivot to something the source brought up regarding who is actually doing this trading. There was a section on behavioral patterns and demographics that I found really, really compelling.
Yes. Now, we do have to be careful here. The source frames this as average trends observed in samples from brokerage account activity.
Right.
It's not a universal rule for every single individual. We're talking about statistical curves here.
Of course. These are big data trends, not personal attacks. But the findings were, well, pretty stark regarding overconfidence.
They were. The data suggests that male investors, on average, are more likely to exhibit overconfidence in their trading abilities.
Overconfidence in what sense? Like thinking they know more than they do?
In the sense of believing they can time the market or outsmart the volatility. This manifests as more intensive trading, moving money around constantly, changing strategies frequently. It's often driven by emotion, that need to fix the portfolio or do something.
So lots of activity, lots of fees, lots of stress, just trying to be a sniper.
Precisely, and usually missing the target. In contrast, the average indicators for female investors in these same samples pointed to a much more restrained approach.
They trade less.
They tend to prefer long-term observation. They aren't trying to beat the market every single hour. They are far more likely to buy, hold, and wait.
And in a market like crypto, just sitting back is.
It's often the winning strategy. The source calls patience the decisive factor. The dead accounts, those wallets that haven't touched their coins in years, often outperform the most active day traders.
So the takeaway isn't men versus women.
No, absolutely not. The takeaway, as the source puts it, is that regardless of gender, the cold approach is the vital advantage. If you can adopt that restraint, that willingness to observe rather than to react, you have an edge.
So the market punishes overconfidence and rewards patience.
It's the great equalizer. If you can be cold, you can win. It's not about who you are, it's about your style.
But being cold is so hard when, like we discussed, your brain is demanding dopamine and the social media herd is screaming at you to buy something.
It is. Which brings us to the practical part.
Right. So what do we do? The source didn't just leave us with the problems, it offered some methods for maintaining emotional balance. And I really like these because they aren't just try harder, they're actual systems.
Yes, you can't just willpower your way out of your own biology. You need structural defenses.
Let's go through them. Method number 1, the information diet.
This is so crucial. The recommendation is to consciously limit the time you spend in specialized chats and forums.
Just log off.
And log off and curate what you see. If you are plugged into the herd 24/7, you simply cannot maintain objectivity. You need to reduce the influence of the noise to actually think clearly. It's about protecting your mental space from that social inertia we just talked about.
That makes a lot of sense. If you're in a room where everyone is shouting, fire,
Ah,
you're going to run, even if there's no smoke.
exactly. Step out of the room so you can see if the building is actually on fire. Limit your check-ins, maybe once a day, or even once a week.
Okay, method number 2. This one I really like because it's so simple. The 24-hour rule.
It's a classic cooling off tactic, and it works wonders in finance. The rule is simple. Deliberately delay any major decision for at least 24 hours.
So if I see a coin pumping and I have that urge to buy, I just stop.
You stop, write down the trade you want to make, and then walk away. The idea is just to step away from that emotional peak. Remember the dopamine rush we talked about? It fades. It has a half-life.
So the next day, the high is gone.
Exactly. If the investment thesis is actually sound, if it's based on logic and not on chemistry, it will still make sense tomorrow.
But if it's just FOMO,
Then, in 24 hours, the urge will be gone. You'll look at that piece of paper and think, what was I thinking?
Yeah.
You will have saved yourself from a bad decision.
I love that. It's like a circuit breaker for your brain.
It really is. And finally, the third method, focus on education.
This one sounds a bit like homework. Go study.
It is homework, but it's the good kind. It's really a distraction technique. The source suggests shifting your attention away from price action and toward the technology,
Why does that help the psychology?
because it engages a completely different part of your brain. Watching the charts triggers the amygdala. That's the fear and emotion center. But studying the blockchain, reading the documentation, understanding the utility, that engages the cortex, the analytical brain.
And you can't really be in both modes at once.
Exactly. When you understand the tech, you're far less likely to panic when the price drops 5% because you understand the fundamental value proposition. You aren't just betting on a number anymore. You are investing in a system you actually understand.
So instead of staring at the ticker and sweating, go read the white paper.
It's definitely boring compared to the green candles, but as we've learned today, boring is where the money is often made. It shifts you from a gambler mindset to an investor mindset.
This has been, frankly, a bit of a wake-up call. We start off thinking we are these financial wizards,
Yeah.
and we end up realizing we are just fighting our own biology.
That is the synthesis of this entire deep dive.
Hmm.
The crypto market is not just about numbers. It is a fundamental test of human nature.
It's a mirror.
It's a test of your ability to control your own reactions. The source sums it up beautifully. Recognizing these biases, the dopamine loops, the unit bias, the social proof, that is what allows you to become a conscious participant
Instead of a victim.
instead of a victim of your own biology. If you don't understand these mechanisms, you are essentially just liquidity for the people who do.
Oof. That's a heavy thought.
Hmm.
You are just liquidity for the people who do.
But it's the truth. The market transfers wealth from the impatient to the patient and from the emotional to the analytical. That is the function of the market.
So what does this all mean for you listening right now? I guess it means the next time you feel that rush or that boredom or that urge to buy the cheap coin with a million zeros, just pause.
Pause and ask yourself, is this the market talking or is this my dopamine talking?
And remember the most important lesson from the source. The real work, the real opportunity happens in the silence.
That brings us to our final thought for the day, something for you to mull over.
We've talked about how the crowd chases the noise and then leaves during the quiet. So ask yourself this. If the best opportunities truly exist in the silence and the boring phases, where are your eyes looking right now?
Are you staring at the flashy noise like everyone else? Or do you have the patience to look where it's quiet?
Thanks for listening to The Deep Dive. We'll see you in the silence.